Introducing Silver Biotics, the preferred colloidal silver supplement of the doc. See SilverDoctors.com for details and special promotional offers today, including a specially formulated 30 parts per million, only available from the doc and other healthcare professionals.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, we finally had an up day in gold and silver on a Friday. As we pointed out several weeks ago, that ever since gold peaked last October and QE to infinity was announced, the metals have been hit with down days on Fridays. 26 out of the last 36 weeks, it was up to 72% of the time. Both metals saw virtually their entire day's gains placed this morning in the nanoseconds after today's PPI numbers were released by the BLS, which were up 0.5% for May after printing a negative 0.7% number for April. So for the week, gold closed on a strong note just above $13.90, and silver held on throughout the access market to close at over $22 at $22.08. But really perhaps more interesting than today's price action was this afternoon's COT report, which at face value shows the commercials covering a massive 40% of the remaining net short position in silver just over the past week, which according to the COT report is now down to only 25 million ounces net short in silver. Basically a 90% reduction from the highs just prior to the announcement of QE to infinity, when the number was around 225 million, if memory recalls correctly. So we spent some time last week, Eric, discussing the CME's recent legal disclaimer regarding the validity of their metals inventory reports, and there's been a lot of speculation recently that the COT report is about as trustworthy as the LIBOR benchmark was two or 3 years ago. So what's your take and your thoughts, Eric? Is JP Morgan really just about net neutral in silver?
I believe they are. In fact, and as our listening audience knows, I've been of the opinion that they most likely have been net neutral for quite some time, and then they just flip around their position on any given week, and then you see the action that shows up in COT as best as it's possibly reported. This week, the COT report statistics end on Tuesday, so this Friday's move is not in those numbers, and this Friday's move combined with the action in price on Monday in particular does in fact support the general picture that the COT is painting, and I think that that's important to point out because we can't take for granted the validity of the COT numbers. But price doesn't lie, and when the price of silver shows us what it has been doing, as is the case this week, it confirms what is being suggested in the picture that we see with the COT. Specifically that JP Morgan and their cohorts don't have a great deal of incentive to push prices much below 22 because that just creates an enormous amount of physical demand, an offtake that pressurizes the COMEX and the LBMA to the point where those two institutions could quite literally implode. And that is not in the interests of the cartel and the interests that the cartel serves. I believe that this is once again fitting into that whole pattern that we've noticed since the beginning of mid-April. The bottom had been set. We saw the May 20th spike down low and Super Bowl bounce thereafter. Monday's failure to see what we were fearing was going to happen leading up into the Sunday thinly traded access hours and then on into Monday, where purchases of silver were on the upside throughout London's trading, just goes to show that the hedge funds are showing the same pattern that they have demonstrated for the better part of 2 months now. Once we hit around 22, the risk reward from their perspective is not that great when it comes to taking on new short positions. And frankly, I think that the JP Morgan gang look at that and say to themselves, we have the risk of creating huge amount of physical demand, and our cohorts and partners in crime, the hedge fund speculators, are no longer interested in going further short. What the heck? Let's just cover some of our short positions and get ready for the inexorable rise forward, because as the fundamentals have not changed, silver and gold are going to move higher, and it's just a question of when. This has been probably one of the longest and most painful 2+ year periods of sideways action combined with a downward bias and attacks that come periodically from the cartel, and then their hedge fund Pavlovian dogs that follow their signals. Like a beach ball underwater, some point it's just got to give. And I suspect this summer is going to see sideways trading with an upwards bias, a lot of chop and a lot of volatility. JP Morgan gang is not interested in seeing things spike up really fast. Today's action is actually, in a microcosm sense, kind of indicative of that. You can see the fact we just shot up immediately in the morning on short covering, but then drifted back downwards as things were calmed and positions were being squared away. So that's kind of an allegory for what we'll probably see throughout the rest of the summer.
I totally agree. It's looking more and more like more of a technical bottom than a sharp V-shaped bottom. Jim Sinclair had previously stated he expected a sharp V-shaped bottom to this decline, but we really haven't seen that. I think just a few days ago he came out and kind of changed his tone on that a little bit. Really, the only way we'd see a sharp V-shaped bottom now is if you saw gold dip to 1200 or 1250 and silver probably to 15 or 18, and just doesn't look like that's a very high probability of happening. So it looks more likely that we're going to have more of a technical bottom that it takes some time to work its way out of.
Yeah, and he's also been saying that we would have a V-shaped bottom as early as like March of this year. Calling it as it is, he's been wrong. He's right on the big picture, but with respect to the short-term timing, his timing hasn't been that great this year.
Right. Just providing listeners with an update on the physical side, as you touched on, the commercials and JP Morgan not too willing right now to push the issue much further just due to the massive physical demand that'll be unleashed. The demand side in the U.S. retail market continues to be a little bit subdued. Premiums continue to tighten a bit throughout the past week. We saw Eagles come down probably 30 to 50 cents across the wholesalers. Most of them are now either live or up to 2 weeks out. And generic rounds came down probably about 10 to 20 cents throughout a lot of the mints and suppliers. And barring a sharp spike down to, say, below 20 to 18 or 15, which we all know would unleash massive new physical demand again. But if price continues to trade in the 22, 23 range for another couple of weeks, I fully expect in another probably 2 to 3 weeks that we're going to see premiums back what they were before this all started back in April. So like on the Silver Eagle side, you'll probably be back to seeing somewhere between $2.60 to $3 over spot at the large retail dealers. We've ran a pretty big sale Thursday and Friday on the San Francisco Mint Eagles as low as $2.69 over. But I think that rather than a big special, another 2 to 3 weeks, premiums I think will tighten up a little bit more. That'll be the normal price if price action continues to consolidate and range trade rather without any more big spike lows, creating new massive demand. Moving aside from the silver price for a little bit, really the big news and the story of the week obviously was the whole NSA scandal with Edward Snowden. In yesterday's Wag the Dog report that Syria has crossed Washington's red line by using chemical weapons against its people. The Obama administration and the rest of the power-drunk federal officials desperately need a major distraction here, Eric. But with Russia backing Syria, any serious U.S.-European intervention in Syria could rapidly escalate to a major regional war, if not entirely to another world war.
Yeah, it's a dangerous situation. It's the tinderbox, and it could explode into something that basically the powers that be will not be able to control. And that's rather unfortunate that our so-called leaders in the West are willing to play this game of chicken. If you roll back the pages of history for the last 13 or some odd years, leading into the Bush presidency and how they viewed the whole Gulf oil reserves and the Cheney Energy Task Force and the documents that came out from that, with Larry Klayman, who was the former director and founder of Judicial Watch, has launched a civil suit against the Obama administration. It's telling, actually, that comes this week because he was forced behind the liberation of the Cheney Energy documents that showed on maps all of the various reserves of oil throughout the Middle East, and it actually suggested the timing sequence of which U.S. military interventions would be occurring. And with the passage of time, it's pretty darn interesting that the theories that surrounded all of the release of those documents are actually fitting with the sequence that we see on the ground. These positionings of the Anglo-American Empire versus general interests of Russia and Syria and their partners, and loosely aligned with China and Iran and Hezbollah within Syria, are setting up a possible colossal clash. If we're crazy enough to continue to try to destabilize Syria as a justification to have an actual physical intervention who knows where that's going to lead. But it certainly would be a lot more destabilizing to the region than, say, our interventions in Libya and the fall of Egypt earlier. It's something that we definitely need to keep an eye on, and from a geopolitical point of view, as far as risk in the marketplace, traders in oil are certainly responding, and that's also been probably part of the reason why we saw short covering, because traders don't want to see a whole weekend pass where they're not able to cover some of their positions in precious metals, because if friction and tension continues to rise in the Middle East, that'll put an additional bid under the precious metals markets.
Bringing the conversation back to the markets here for a minute, Eric. This upcoming week we have the FOMC meeting, and really the last FOMC meeting, I think it's until September, outside of Jackson Hole, which Bernanke's not going to be a part of, reportedly. Really for the last 2 months, the Fed has been hinting throughout their various mouthpieces, their Fed pieces, that they're going to be tapering soon, and that's been all the rage. We had that big Hills and Ranth article, I think a month or two ago now, which was then backtracked a couple of weeks later. I really don't see the Fed next week announcing any tapering. I don't think they can afford to, where we're at right now. What's your take, Eric, on the FOMC meeting coming up next week, really the last one for the summer here?
Given the fact that the stock market has been somewhat wobbly within the last month, I would not be surprised that Bernanke gets his mouthpieces amongst the people on the Fed to start issuing a different change in the tone of the minutes to the direction of being a little bit less insistent that they're going to begin tapering. The timing would be right for that cycle, and we've seen this thing oscillate back and forth between let's be a little bit more suggestive of the fact that we're going to curtail and taper for a period of time, and then all of a sudden, as soon as the stock market starts rolling over, as we saw in the latter period of March, and the whole notion of curtailing the bond purchases immediately gets taken off the table, and you see people like Fed Governor Lakota coming out and saying, well, we can continue to see Fed purchases well beyond 2015 if need be. But more specifically with respect to data that supports the idea that the Fed is just not going to do anything, a really interesting report came out for April foreign investor flows for Treasuries. There's a statistic called the TIC report, and it measures the foreign capital flows of big investors and sovereign entities like China and Japan and Saudi Arabia and so forth, and what they're doing when it comes to their purchase of our bond. And in April, official and private sales were 54.5 billion net sales, which is the largest amount of U.S. bonds, treasuries, being sold by foreigners in the entire history of this recorded data series. The numbers really much speak for themselves. The Fed can't stop buying treasuries because there are not enough individual investors and pension funds and other U.S.-based investors who are interested in picking up these paltry offerings with their minuscule interest rates. I mean, why would you want to buy something like that for the long term when it doesn't compensate you against inflation, never mind the risk of debasement of the dollar and so forth? So the fact that the U.S. domestic market is weakening and the treasury prices are backing up, combined with the fact that the foreigners are also ditching this stuff, means that the Fed has to be the buyer of last resort. And if the elites in Washington want to avoid a bond market crash, they have to continue to push the Fed to vacuum up these treasuries, because no one else is going to be able to be in the market as the buyer of last resort, and demand is declining. All this talk about tapering is just BS, frankly. The situation is only getting worse. It's possible that the Fed might have minutes that suggest completely the opposite picture that I'm speaking to now, but when it comes to a 3-month and beyond window, they can't dance around this much further.
Yeah, I couldn't agree more. Really, over the next week, we have the Fed meeting, continue to watch progression of the NSA scandal and what looks like a cover-up as far as rather than cover up, news shift attention to try to get the MSM covering another story with the Syria rhetoric being ramped up. And we have gold ready to retest 1,400. So it'll be another interesting week to come. Once again, for Eric Dubin and the Doc, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.